Most people think life insurance for kids or young adults don't make sense. They don't have income. They don't have any dependents. Why would you insure someone so young? But here's what most families don't realize. When it comes to life insurance, age and health are your greatest assets. And the decision you make early can either create long-term leverage or close doors forever. Today, I'm going to break down term life insurance versus whole life insurance for babies, kids, and young adults. What actually makes sense and how families can use each one strategically. So let's get started. Now, why people even consider life insurance this early? Before we compare policy types, we need to understand the reason families even have this conversation in the first place. And before we talk about policy types, we need to address the why. Life insurance for young ages is not about income replacement. It's about insurability, cost control, and long-term flexibility. When someone is young and healthy, rates are at their lowest. Medical underwriting is easiest, and future health risks are locked out. Once health changes, options shrink. I see this every year. So parents and young adults aren't buying life insurance because something is likely to happen. They're buying it because something might happen later, which can limit their choices now. But here's the question parents ask me. Why babies and children under 18 don't qualify for term life insurance alone? So let's clear up this confusion. Babies and children under 18 typically do not qualify for a standalone term policy. And the reason is simple. Term life insurance is designed to replace income. Children don't earn an income. Because of that, insurance companies don't issue traditional term policies on minors by themselves. Instead, term coverage for children is usually offered as a rider attached to a parent's policy. Why? Because parents earn income. But why would parents consider term life for babies and kids? Now, when attached to a parent's policy as a child rider, the term policy provides a small fixed death benefit, which can cover all eligible children in the household, and it has no cash value. It ends when the child reaches a certain age. So term insurance for children is limited by design. It offers temporary protection for no long-term control or guarantees. That's why families who want permanent coverage or future flexibility have to look beyond term. Now stay with me. We're going to stick with term insurance and look at term life for young adults. The conversation around term life changes significantly. Term insurance is simple. It provides coverage for a specific period of time, 10, 20, or 30 years. If the insured passes away during that term, the death benefit is paid. If not, the policy expires. For young adults, term life is very affordable, works well for temporary needs, and is commonly used for income protection later. But term insurance is best used when the goal is a short-term protection, budget is the primary concern, there is no long-term planning objective. But term has one major limitation. When the term ends, the coverage ends. And to renew the coverage becomes a bit more expensive, which is a major consideration since whole life is most affordable at a younger age. This leads us to whole life. And we'll start with this. Whole life for babies and kids. Because term insurance have built-in limits for children, this is where whole life insurance comes into the conversation. Whole life insurance for children is not about replacing income. It's about guarantees. Whole life insurance lasts for life, builds a cash guaranteed value, locks in insurability permanently, and parents use whole life insurance for kids to guarantee future coverage regardless of health, create a financial asset that grows over time, and give their children flexibility later in life. That cash value can eventually be used for educational expenses, a home down payment, business opportunities, and emergency needs. This leads us to limited pay life insurance. Once families understand whole life, the next logical question is how long premiums last. This is where limited pay life insurance comes in, a variation of whole life that many families don't know exists. This type of policy allows you to fully pay for a lifetime of coverage in a short amount of time. Common structures include 10 pay, meaning you pay it off in 10 years, 15 pay, you pay it off in 15 years, or 20 pay, you pay it off in 20 years. And the last one, paid up to age 65, which means you pay it off by the age of 65. Here's where families like this option. You make the payments for a limited number of years. After that, the policy is fully paid up. No more premiums. But the coverage and cash value continues for life. Parents often use limited pay life insurance to finish paying for a child's policy before college, avoid premiums during retirement, and transfer a paid-up asset to their children. And finally, create certainty around long-term planning. A disciplined approach that trades a shorter payment window for permanent benefits. Now let's move the conversation forward into young adulthood, where cost, flexibility, and long-term care planning intersect. For young adults, starting early means lower lifetime premiums, faster cash value growth, and long-term financial control. This is the point where many young adults push back the hardest. Most young adults say, the same thing. I'm healthy. I'm young. I don't have kids yet. I'll deal with it later. Here's the reality. The young adult age range is the most affordable window to buy life insurance. Premiums are based on age and health. Every year you wait, the cost goes up. One diagnosis can change everything. Young adults who act early benefit from the lowest possible premiums, the most underwriting flexibility, more product options, and long-term control over their financial plan. Term life works well when income protection is the goal. Life insurance works well when long-term planning and flexibility matter. The biggest mistake young adults make isn't buying the wrong type of insurance. It's waiting until the insurance becomes expensive or unavailable. So which one makes sense? After walking you through each option and how it works at the different stages, the decision becomes much clearer. Here's a simple breakdown. Term life makes sense when you want low-cost, temporary protection, when your budget is tight, and the need is short-term. Whole life makes sense when you want long-term coverage, you want to build long-term financial flexibility. For babies and kids, whole life is often future-proofing. For young adults, it's about locking in options early. For families, it's about creating stability across generations. So, life insurance at a young age isn't about fear, it's about foresight. The earlier you plan, the more control and the fewer surprises life can throw your way. Now, if this content was helpful, please share it with someone who may benefit from this topic. And don't forget to like, share, and please subscribe to the channel. But don't stop here. Check out my next video right here for more insurance and financial tips. And as I like to say, call Jay today.